Hey everyone, and welcome. Today we're going to pull back the curtain on a really interesting puzzle that happens in pretty much any business that sells a physical product. We're talking about inventory discrepancies. It's kind of like a ghost in the machine that accountants have to track down, and we're going to see exactly how they do it.
Okay, so to get our heads around this, let's start with a super simple idea. Imagine you pull up your banking app, right? It says you got $100, but then you open your actual wallet, count the cash, and you only find 90. There's a $10 gap between what the system says you have and what's really in your hands. You wouldn't just shrug and move on, would you? No way. You'd want to figure out what happened to that missing $10.
Well, believe it or not, businesses deal with this exact same problem, just on a much bigger scale. So what actually happens when the number of items a company thinks it has in its warehouse doesn't line up with the number of items they can physically touch and count? That's the big mystery we're unpacking today. And this whole mismatch thing, it actually has a name, the phantom inventory problem. It's exactly what it sounds like. It's when a company's records, the books, show more inventory than what's physically there. It's inventory that exists on a spreadsheet, but in the real world, poof, it's vanished. This slide really lays the problem out for us in black and white. The computer system says, hey, we've got 1,000 units ready to go. But when an employee goes and does a physical count, they only find 980. So 20 units have become phantoms. Now, where did they go? Who knows? Maybe they were damaged. Maybe they were stolen. Or heck, it could have been a simple shipping error. Whatever the reason, we've got a gap, and it absolutely needs to be fixed.
So you might be thinking, okay, 20 units out of 1,000. Is that really such a big deal? And the answer to that is a huge, resounding yes. Let's dig into the ripple effect of what seems like just a tiny little error.
You see, that discrepancy isn't just a headache for the warehouse manager. Oh no, it's a direct threat to how accurate a company's financial reports are. And this is serious stuff. Big inventory write-downs have literally sent company stock prices crashing because it tells investors that management might not have a solid grip on the business. So accurate reporting, it's not just good practice, it's the absolute foundation of trust. And to really get why that trust is so critical, we need to talk about one key accounting term, the cost of goods sold, or COGS for short. Basically, this number represents all the direct costs of making or buying the products that a company has sold. Just think of it as the cost of everything that walked out the door in a customer's shopping bag.
So here's the domino effect, right? If your inventory number is wrong, your cost of goods sold will also be wrong. It has to be. If those 20 phantom units are just gone, their cost has to be recognized as an expense. If you don't fix it, your assets look bigger than they are and your expenses look smaller. This leads to an inaccurate gross profit number, which can cause the people in charge to make really bad decisions. I mean, imagine ordering millions of dollars in new stock because you think your sales are way more profitable than they really are. Yikes. Ultimately, it all leads to misleading financial statements, and that can destroy investor confidence and even get you in trouble with regulators.
So how in the world do accountants clean up this mess? It's not like they can wave a magic wand and make those 20 units reappear. Instead, they have to make the books match reality. Let's take a look at how they do it.
The fix is actually a pretty clever accounting move called an adjustment, and it specifically involves tweaking two key accounts to get everything back in balance: the cost of goods sold account and, you guessed it, the inventory account itself.
Okay, so here's the game plan, step by step. First, you lock down the discrepancy. That's our 20 missing units. Second, you adjust the cost of goods sold. Since those units are gone, their cost is now an expense, so you actually increase CGS. Third, you have to adjust the inventory account. Since the items aren't there anymore, you have to decrease the value of your inventory on the books. So you increase one, decrease the other. Boom, the books are back in balance, and most importantly, they reflect reality.
The adjustment's been made, but we're not quite done. There is one final, crucial step to lock it all in and make it official for the year.
This last step is called a closing entry. And you can think of it like the accountant's version of hitting the save button on a massive document at the end of a project. It's so important because it finalizes the changes to the cost of goods sold, officially moving that expense over to the income statement. This makes sure the changes are permanent and correctly shown in the official year-end reports that everyone, from investors to the government, is going to see.
And this right here, this is the end goal. The whole point of this entire process, from physically counting boxes in a warehouse to making these detailed entries, is to make sure that a company's financial statements are honest and accurate. They have to show the correct, true value of the inventory the company actually has.
So, the next time you hear about a company doing an inventory count,
you'll know it is about so much more than just counting boxes. It's about hunting for phantoms, making sure the books match the real world, and ultimately about telling the true financial story of that business. Because at the end of the day, what good is a story if it isn't true?